Welcome to the Tesla Economist. Please hit the thumbs up and don't forget to subscribe. Just to be clear, this is a video about how Tesla stock could reach $3,000 by 2023 and what would need to occur in order for it to achieve that valuation. In no way am I implying it will, I just like to run models and see what results I get. Given the current stock price, we're talking about approximately a 400% increase in 2 to 3 years' time. That's a great return in the market, or anything else for that matter. So to make such an outlandish statement, I need to back it up with some serious math, not just hopes and dreams, and if they did this or if that happened type hyperbole, and not pulling any numbers out of thin air, but all backed by proper analysis. I'm a big fan of econometrics models, and I'm somewhat proud of the fact my econometrics model for Tesla's 2020 Q4 revenue was within 1%. So let's see if I can back up my claim of a $3,000 stock price sometime in 2023. And as the title said, can, not will. So let's first cover some of the assumptions in order to get there. Let's assume that the entire economic and financial systems have not come to a total collapse for any reason, whether economic, financial, war, or pandemics. Another assumption is that Tesla will not have supply chain issues and have secured enough batteries for all their necessary production. So let's work backwards from here and start with what they will need to achieve to deserve a $3,000 price tag. That is approximately a $3 trillion market cap. Okay, I know it's slightly less than that, but let's just stay with that for some easy numbers. I think by the end of 2023, it's highly possible Tesla could see a run rate of 5 million cars a year. Note that I said at the end of 2023. That doesn't imply they will do 5 million cars in 2023, although they possibly could. Now, if Tesla is still only at 5 million cars, according to Tesla, their target is 20 million. So we're still only a quarter of the way there. Given that there is still literally 400% more growth in sales, then I'd like to think a P/E ratio of 50 is still reasonable, especially when you factor in the other sides of the business. So if we want a $3 trillion market cap and a P/E ratio of 50, then we're looking at $60 billion net profit. I want to base this model on what I understand and can calculate, and somewhat guided by projections Tesla has given us. Given that, I want to exclude anything from energy. The energy business is growing, but it's currently making a loss. So I want to build this model solely on the auto sales, just for good measure. And we'll assume that at worst, the energy business is just breaking even. We'll also be excluding any regulatory credits. I'm sure by 2023 they'll be actually even higher than they are now, but we can't depend on them. So will Tesla be able to make $60 billion profit from selling 5 million cars a year? Well, let's look at Tesla's financials. In Q4, their auto sales were $8.913 billion, excluding regulatory credits, with a total cost of $7.07 billion, leaving a gross profit of $1.843 billion for autos. But then we have to remove all the other expenses to get to net profit. These include depreciation of $618 million, stock-based compensation of $633 million, research and development of $522 million, selling, general and administration $969 million, and interest expense of $246 million. Once you take out these numbers, then you arrive at the net profit. And yes, admittedly, some of these expenses are for the energy side of business, not just auto-related. But when auto sales increase, how much of these expenses will actually rise with the sales? Well, stock-based compensation is only for when Elon hits his bonuses, and eventually they will come to an end. Research and development, although it will likely increase, is in an area of its own. Every dollar invested in R&D will come out as profit somewhere later, perhaps like a new efficient battery that costs even less to produce, thus increasing margins a further 2%, which would be worth billions a year. The interest expense shouldn't really increase. Tesla have plenty cash on hand, and the more profits increase, then the less they need to borrow. So that comes down to selling, general administration, also known as SG&A. If Tesla increase in size, then sure, the SG&A will likely increase too, but I think there is still an intrinsic amount that is required anyway, and once Tesla grow, then I don't think these costs will need to grow relative to the actual increase in sales. To sum up, when this gross profit increases to these forecasted levels, I don't believe the expenses that are not related to the cost of goods sold will increase as much, so the net profit margins will increase along the way. Okay, so how much gross profit will they be up to by the end of 2023? Just to be clear, I do not mean how much gross profit will they do in 2023, but what their annual equivalent would be by the end of 2023, as this is what the share values will be based on. You base share values on what a company is doing currently, not their average for the year. So back to our figure. we calculated a gross profit of 1.843 billion for autos. This came from a delivery of 180,570 cars. Now, it doesn't take a calculator to work out that that's approximately $10,000 profit per car. And this is just from Model 3 Shanghai and Fremont. Fremont is still using older, less efficient processes, not to mention being based in California alone means costs are just naturally higher. And China generally sells cheaper models with very few ordering FSD. In other words, Fremont has higher costs and China has lower average selling prices. Collectively though, their current capacity is just over 1 million cars a year. I say only because we expect Berlin and Austin to be at a run rate of around 3 million cars a year when they ramp up. But by the end of 2023, I find it likely these factories should have increased their total capacity to 5 million, i.e. 20% improvement over nearly 3 years is not unrealistic. And the new factories are not only using the new manufacturing processes, but also using the new batteries, and likely selling a lot more of the higher end models along with more FSD. In addition to that, Fremont is picking up a lot more S and X sales too, so we should see more revenue coming out of there. But even if they don't achieve these run rates, we're talking about the end of 2023, I would say that there should be at least 2 more factories operational by that stage anyway. So that was a long way to basically say I expect the gross profit of $10,000 a car to increase to closer to $15,000 a car, and with 5 million cars, then that comes to $75 billion gross profit a year. And to achieve our $60 billion net profit for $3 trillion market cap, we would then have $15 billion spare to cover the increase in expenditures we may see from R&D and SG&A, and any new factories and capital equipment, which just might cover it all. Let's exclude robotaxis from this model, as it's a variable. I think there's a chance they could have started in some cities by then, but I'm not privileged enough to have access to the data to know. However, there will be some advances in FSD by then, meaning that Tesla will be taking more profits from FSD orders because it will have increased in price by that stage, and they don't have to place as much of the income in deferred revenues. Tesla might have made some progress in regulation too, perhaps not allowing the car to drive you autonomously anywhere, but possibly fully autonomous on highways, interstates or motorways. The majority of time people spend in traffic is on these types of roads. So if you were now able to just sit in your car and watch Netflix, or use your phone, or perhaps do some work on your laptop, while the car drives you through the mind-numbingly boring traffic jams, that's some serious value, something that people are willing to pay for, and a significant extra reason for more owners to upgrade to full self-driving, thus further increasing the average selling price per car. And then for good measure, we can add a bit of padding in there for the energy business. At this stage, it's really hard to do any modelling on the energy. The batteries are currently predominantly used for vehicles, as they're so much more profitable. But if Tesla are finally able to make more than enough batteries for their cars, then this side of the business should start adding some significant revenue too. It's likely that Model 2 might start production in 2023, but I wouldn't have thought it would have reached any critical scale that year to have a significant impact. And although the profit margins on them are likely still going to be good, they aren't going to be good as the other models, and the fact the price is so much lower, there won't be as much profit in general. Remember, the title of this video is how Tesla could reach a $3,000 stock price, not Tesla will reach a $3,000 stock price. This is one way it could happen, just through auto sales alone. They may fall short and only reach about 4 million deliveries by that stage, but the stock price is still going to likely be sitting north of $2,000 if that was the case, which is still a really good return and fine with me. But I believe there are enough other activities Tesla are pursuing to actually give it a reasonable chance of hitting $3,000 in 2023. This is not my price target, I'm just saying it's a possibility. On the other hand, they could announce Level 5 autonomy next month and instantly hit that valuation overnight. And I didn't include any of their energy activities either. Either way, there is no doubt about it, this company still has a lot of potential and it's barely begun. Thanks for listening, please hit the thumbs up and don't forget to subscribe.